Okay, let's go.
You can have the cleanest chart markups, perfect confluences, and absolute precision on your entries. However, without the self-awareness to manage your own behavior, that technical edge often disappears the moment you encounter market pressure. Today, we are going to build a framework to fix that. Even the most robust trading strategies clack under pressure when the internal structural support, your mindset, fails to hold up. Here is what most people miss. You are not actually trading against the market. You are engaged in a constant daily battle against your own cognitive impulses. The charts are simply reflecting your fears and hesitations back at you in real time. To stop repeating these emotional patterns, we are going to use Dr. Brett Steenbarger's Trading Psychology 2.0 framework. This system takes abstract concepts like discipline and translates them into a mechanical daily routine. Before we start, you need a dedicated operational hub. Grab a physical notebook or open a fresh digital workspace. This will serve as your data tracking center for your most important asset, your own daily performance. Implementing a strict self-coaching system is the exact dividing line between professionals who achieve lasting consistency and amateurs who stay trapped in a cycle of blown accounts. Step 1 happens before you ever look at a chart. You must write down one highly specific, measurable psychological focus for the day. This intention must be actionable. For example, today I will wait for a complete 5-minute candle closure before entering any trade. As you move into the live trading environment, keep that written intention visible on your desk or screen. When market volatility spikes, that single sentence anchors your mind and keeps you emotionally regulated. Once you are executing trades, you have to follow the earn your size principle. Many traders fall into the trap of scaling up their position sizes prematurely, hoping to chase larger profits. As risk exposure increases, emotional logic plummets into the red, shifting you into panic-driven survival mode. To correct this, drastically reduce your position size. Pulling back risk restores balance, allowing your operational confidence to climb back into the green zone. Managing your position size protects your cognitive bandwidth, serving as a mechanical rule to ensure you can actually follow your plan rather than just surviving the trade. Step 2 requires a rigid end-of-day boundary. The moment your trading session finishes, before you close your laptop or check social media, you begin your review process. You will answer exactly 3 questions. What went right today? What went wrong? And what specific adjustment will I make for tomorrow? The primary failure point for most traders here is using their journal as a diary to record emotional frustration and self-criticism, rather than tracking objective data. This visual shows the difference. You must adopt the perspective of a sports coach. You drop the useless self-attack on the left and replace it with clinical curiosity and objective adjustments on the right. You are analyzing the process, not attacking the person. Your final daily entry task is explicitly documenting one small win directly below those 3 review questions. A small win is a procedural victory. It means you honored your stop loss, or you walked away from the screen when you felt yourself tilting. You record this regardless of the day's financial outcome. Compounding these microscopic process wins over time acts as a psychological anchor. It actively rewires your subconscious to expect and continuously execute strict discipline. Now we shift from daily execution to the weekly review. Raw journal entries are useless until you analyze them over the weekend to identify recurring behavioral patterns. This data reveals your optimal strategy through a concept called strength-based trading. Every trader possesses a unique psychological profile, and your job is to discover yours. Different trading styles require completely different cognitive demands. The rapid-fire reactivity necessary for fast scalping is the exact opposite of the deep, methodical patience required for slow, structured swing setups. You cannot force yourself into a style that contradicts your nature. Like these contrasting currents, you have to let the fast, reactive behaviors and the slow, dense strategies diverge perfectly into their own optimal channels. Your task is to align your technical trading plan explicitly with the psychological strengths you uncover in your weekly data review. A durable trading edge emerges when precise market mechanics intersect with your personal psychological alignment. The complete daily sequence is locked in. Set your intention, control your position size, execute the 3-question review, log the small win, and extract your weekly data. Now we issue the challenge. Commit to this exact unbroken tracking period for 21 days. By checking off these days, you systematically overwrite dopamine-driven trading with mechanical discipline. To support your development, the Funding Pips community is giving away 5 25K 2-Step Pro Challenge accounts. To enter the giveaway, leave a comment below with your biggest takeaway from this video and specify the exact new routine you will add to your trading day. Make sure to follow our weekly schedule. We have success stories on Wednesday, trading psychology on Friday, and beyond the charts on Sunday. Giveaway winners will be selected and announced on Thursday's blog. External capital can be awarded, but the internal consistency required to keep it can only be built by you, one self-coached rep at a time.